In a week dominated by central banks, Thursday sees the likes of the SNB and the Bank of England step forward. Really, it's likely to be a sort of afterthought in the wake of the FOMC meeting on Wednesday. But nonetheless, we are expecting to see easing from the SNB. And we have got some question marks over the direction of travel for rates in the UK coming off the back of some weak GDP data last week. And so this is going to be an opportune moment to take a look at both of these regions and wonder exactly where we're going from here. So let's kick off with the UK. Notably, you can see headline and core inflation moving towards the upside in the UK. But that comes despite the fact that we're seeing relative weakness when it comes to monthly inflation data. You can see that the negative readings from last time around weren't necessarily as negative as the January from 2024. And that's why we saw base effects really kick in and push inflation higher. But look at the bottom section. The 8-month annualized metrics essentially signal a move below the 2% mark by the midpoint of 2025. And that provides the basis for the Bank of England to do pretty much whatever they want, right? Whatever they deem to be necessary. They don't necessarily have their hands tied. At the moment, it looks like they do, right? So core 3.7, headline 3%, and moving higher since those lows that we saw in sort of September time. But there's a good chance that things start to turn around. You can see how base effects could come into play in the coming months, because February, March, April, and May of last year saw significantly sort of above trend monthly metrics. And once they're stripped out and replaced, as long as we don't see similarly high metrics coming into play, then there's a strong possibility that we see disinflation really kicking in. Now, the Bank of England aren't necessarily going to just front on that too much, because we are in a position where this is still the unknown, right? We haven't seen that latest data, but there's a good chance that in say 3 to 4 months, we're going to see inflation significantly lower from where we are at the moment. One of the charts that we've been looking at recently is the sort of relative ratio between US yields and yields elsewhere around the world, right? Most notably in the UK or in Europe, where the US is in a pathway to try and drive down their debt. They're trying to lower yields. They're trying to cut back on government expenditure and the like. And meanwhile, they're sort of breaking relationships around the world. And that means that the Europeans are having to go it alone. So the prospect of higher spending in the likes of Germany and the likes of the European Union, to an extent the UK, does provide the basis for higher yields, higher borrowing costs. And therefore, that's why you sort of see these sort of currencies moving in tandem with yields. And so we can look at the same kind of thing, but in terms of what's happening in Europe. And notably, we haven't necessarily seen a huge amount of movement in terms of the longer term yields, but we have in terms of the 1-year yield. So greater expectations of even easing in the near term for the UK. So that's pretty significant and does highlight the direction of travel people think for the near term, but not necessarily too far out. In terms of expectations for this meeting, you can see 88% chance that we don't see a cut. Markets instead expecting May to be the time that we see a cut, 59% chance of that. And then from there on out, you're looking at potentially another one rate cut down to 4% before the end of the year. So not a huge amount of easing currently being priced in from here onwards. You can see, we're talking about 1, 2, 3, 4, 5, 6, 7 meetings, 2 cuts. So look, I've already told you, I think inflation's going to come in soft over the coming months ahead. There's a greater degree of a potential breakdown for trade relations between the likes of the US and Europe, sort of mainland Europe, European Union, than the UK, because the UK still maintains a trade deficit with the US. So the UK is likely to be in less of a troublesome picture going forward. And so, will they need to cut rates? Yes, but do they have the sort of inflationary problem that's likely to come elsewhere? I wouldn't necessarily say it's as likely, quite frankly. That being said, disinflation in the Eurozone certainly well underway. So we can see here in terms of euro sterling, let's just jump on euro sterling. There we go. So euro sterling, from a daily perspective, you can see that we do have this ratio between the European 10-year yield and the UK 10-year yield in relation to the euro and the pound. So you can see how we've seen this big pop recently in line with a number of things. But of course, we've seen things like the Germans saying that they're going to change their borrowing rules and looking to sort of raise 500 billion euros. European Commission talking about 800 billion euros to be spent on defense. So we've seen this big pop in terms of relative yields for the euro area, and that has helped pop the likes of euro sterling quite significantly. The question mark here is, are we going to see this reverse? Because if we look from a sort of wider perspective, you can see that the downtrend still remains very much in play here for euro sterling. We can see here, if we sort of grab some of these tops, there's a rough trend line resistance coming into play here. So look, I mean, ultimately we are seeing something change, right? We're seeing something change in mainland Europe that isn't necessarily something that has been in place previously. So if they're suddenly going to ramp up spending and they're going to ramp up debt, then there's a high chance that we see higher yields, and therefore you have the possibility of a bottom here for this market. Let's just look from a wider perspective. Now, what's notable about it is that we've come into this zone of previous support where time and time again we have bottomed out, right? Sort of 0.82, 828 kind of area. So this is the kind of area that we could see this pair bottom out. And yeah, let's see exactly how things play out in terms of this meeting. Are we going to see the likes of the Bank of England essentially laying a pathway for greater easing in the months ahead than markets are currently pricing? If that comes to fruition, then there's a possibility that we see further upside in terms of the relative yields of the euro versus the UK, and that points towards a bottom for euro sterling. Look out for that resistance level, which is up ahead here at 847. Now let's look at the FTSE 100. The FTSE's been doing very well of late. We can see here from a wider perspective, it's not the kind of index that, you know, the people are used to over in the US, right? So let's look at the S&P 500 on the same scale. It's not a great index over the years, right? You know, it's, for many years, it will just sort of stagnate. It will just go sideways. But, you know, with the pullback that we're seeing recently in terms of the S&P 500, you know, what's it like in terms of, let's just replace that with, say, UKX, that to that, that to that. What's the relationship between the two? Well, you can see the UK FTSE 100 typically underperforms. That much is very clear. So it keeps going down and down and down. That means that if you want to be long someone, you want to be long the S&P 500 historically. But what have we seen recently? Oh, we've seen a bumper run, partly driven by gains in the FTSE 100, partly driven by weakness in terms of the S&P 500. Let's just do that. Okay, we can go same scale. So here we go. So the S&P 500 we're seeing coming off, which shows you that this sort of leg of that outperformance was largely driven by just the S&P 500 weakening, because we've also seen some weakness in terms of the FTSE. But then prior to that, we did see some strength for the FTSE, a sort of breakout as we were seeing consolidation here for the S&P 500. So it's been a mix of the two, but certainly it feels like European and Chinese equities right now are sort of coming into favor as US equities are selling off. And so it provides a tailwind for the FTSE 100 if we were to see a relatively sort of loose policy from the Bank of England. So, you know, we've seen a bit of a pullback recently, but it comes off the back of this breakout. And so I wouldn't necessarily think too long and hard about it as if it's like a top or anything like that. Look, we've come into what was resistance, now support. In terms of fib, you know, do we have a sort of 50% there maybe? Let's see. Yep, slap bang on the 50%. There we go. Absolutely perfect. So yeah, 50% retracement, resistance turns support, long lower shadow. That to me points towards this market likely continuing to move towards the upside. And if we see a relatively dovish stance from the Bank of England, then that will embolden calls for upside when it comes to the FTSE 100 and make people feel more positive about things in the UK. Now, in terms of the Swiss region, It's notable that the SNB has already been cutting to a large extent. Now, where's the outlier to this chart? It's the vibrant green line that we can see at the bottom there. And that is the SNB. They didn't hike to the same extent as of the other central banks. They started from a lower level, and now we're sort of approaching the zero mark. So are we going to see negative territory for Swiss rates? That remains to be seen. At the moment, they're sort of not saying they're going to do it, but not saying they're going to rule it out. It depends where they go from here. Now, one of the things about Switzerland is that they've got inflation that's pretty much non-existent, right? So inflation has dropped and dropped and dropped. And we saw a strong monthly print in February, but as you can see from February from last year, that is by and large a seasonal factor. And so it's not necessarily something to worry about. Swiss inflation remains rock bottom, and that provides the basis for them to ease as much as they need to, quite frankly. In terms of market expectations, you can see here that there is an expectation we see a cut this time around. That's down to 0.25 from 73 essentially, but this could be the last one, right? And that's pretty notable. It's probably the case that people are now going to look at this and think, well, the relative moves. So, when we're looking at say yields, right, the relative yields, that's what's been driving some of these markets, right? So when you're looking at US 10-year yields relative to UK 10-year yields and overlaying cable, things like that, right? That points towards the fact that if we've seen a central bank already enact all of its easing and then it stays put, and then another central bank that hasn't eased at all then starts easing or takes a much more dovish turn, that's likely to bring weakness for the other currency, despite the fact that their rates are significantly higher than the SNB. So it's an interesting one. It points towards potential strength for the Swissy at a time where they've got pretty much rock bottom, near enough zero rates, and they're cutting rates this time around. It's a really interesting one, really. So let's look in terms of the chart. And the chart here we want to talk about is the US dollar against the Swiss franc. And part of why I think this is particularly interesting, if I sort of go full screen, part of why I think this is particularly interesting is because this weekly time frame shows you this. We've got this really clear sort of range, really very clear. At the top end, we've got this sort of zone. Let's get on to something a bit more normal. So 918, 924, that kind of zone. And on the bottom end, we've got sort of roughly down sort of 84, that kind of thing, right? We did have a low here as well. So 84, 855, but we're in the middle of it. So it certainly points towards the idea that we don't necessarily have a huge amount of support down below. We have got the justification for further downside. If you look from a long-term perspective, it has weakness here. So strength for the Swiss franc, weakness for the US dollar. And so, the wider trend plays into it, the range plays into it. I think there's a good chance we do see further downside, even if we see easing from the SNB. Now, part of this comes because of the relative change. The relative change isn't on the Swiss side of things. The relative change has been on the US side of things. We've gone from a position where people were questioning whether we're going to see a rate cut at all this year to suddenly people saying, we're going to have a recession, we need to see 3 rate cuts this year and things like that, right? And so the relative shift has happened on the US side of things. That's what's driving weakness here. It's notable, of course, that we've got the FOMC interest rate decision on the Wednesday, and that means that the relative shift could actually favor the US dollar. If they come out and say, we're not going to do anything anytime soon, then it does provide the basis for people to maybe ease back on those expectations from the Federal Reserve. But nonetheless, it certainly looks to me like we're setting ourselves up for further downside. And you can see that in the 4-hour chart, really clear here. Sort of deep retracement, that often happens at peaks, right? So double top formation, flat highs, because you've got that battle between the bulls and the bears. The initial signal that we're topping out came with this, right? So we broke through that support level. That points towards the next rally being a likely retracement, but often a deep one because the bulls still think they're in charge. That's exactly how it's played out. We then saw the next retracement looking like a sort of 76.4 deep fib retracement. And then once we start to break through support here, that's when we start to see some confidence coming into play. So sort of shallow to mid-sized retracement, probably a 38.2. We come into a deep retracement. Now we've come into a very shallow one and then pretty much non-existent one, almost like that's the entire move. Now we've come into what looks like a sort of rising wedge formation. We can sort of look at that here. So you could draw it there. You could draw it down to, well, there, and then down like that. So you know, you're talking about a bearish formation here and essentially a continuation pattern. So we've had that breakdown now with the fact that price is breaking through this support level that we have at, there we go, the first support level, 0.88. Let's go on the hourly now. So we've seen sell-off, consolidation, sort of retracement. If you're looking at it from this intraday basis, what's that, 50%, maybe 61.8. Yeah, 61.8. So 61.8 retracement, we then break down through support, and that points towards further downside to come. And now we're seeing on the sort of short-term basis, shallow retracement, sell-off, mid-sized retracement, selling off once again. So it does look like it's setting up for further downside to come. And like I said, a lot of this all comes down to relative pricing for yields in the two countries. And with the SNB, yes, planning to ease, and the Federal Reserve not planning to ease at this meeting, you might think it's all about weakness for the Swissy, strength for the US dollar. That might not necessarily be the case, but a lot of it comes down to what the outlook will be from the Federal Reserve. If they come out and essentially say, well, I know markets are thinking we're going to see a recession and that we're going to have to cut rates loads of times, we don't see it at all, then, you know, maybe we do see some upside for this pair. But right now it does look primed for further downside in my mind. I hope that's been useful. Of course, we're going to continue to provide you guys with lots of content, the daily shorts, previews for some of these events, and more. Keep an eye out for more on the Scope Markets channel. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading.